Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 May-June Paper 2-2 question number 3. This is paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit for this paper is 1 hour and 45 minutes. Since question number 3 is of 15 marks, ideally you should be spending about 17.5 minutes in order to complete this question. And in this video as well, we'll be attempting to solve this question under 17.5 minutes. So without any further delay, let's get started. Suki uses ratios to assess her business's efficiency. The following information is available. For the year ended 31st December 2023, we have been given the value for the purchases and the revenue. Then at 31st December 2023, which is the closing date, we have the values for the trade payables and trade receivables. All goods are purchased on credit. So this value is the total for our credit purchases. And 80% of sales are on credit. So credit sales will be 80% of the total sales. And in this case, the total revenue is given to be 482,500. And 80% of this value will be the credit sales. That will be 386,000. Now for the first part of this question, we need to calculate the following ratios stating the formula used. The first one is trade payables turnover. The formula for trade payables turnover is trade payables divided by credit purchases times 365. Now we can substitute the values. We have been given the value for the trade payables to be 33,600. And we know that in this case, the total purchases will be equal to credit purchases, which will be 323,000. This results in the value of 37.97. And in this case, we need to calculate the turnover ratios in days. And whenever we are calculating any sort of ratio in days, we always need to round it up. And since in this case we have 37.97, the final answer will be 38 days. Now for the second part, we need to calculate the trade receivables turnover in days. And the formula for this ratio is trade receivables divided by credit sales times 365. Let's substitute the values. We have our trade receivables to be 34,100 and we calculated the value for the credit sales to be 386,000. So 34,100 divided by 386,000 times 365. This results in the value of 32.24, and again, since we need to calculate it in days, we will round it up. So the final answer will be 33 days. Now we have been given additional information. At 31st December 2022, the following ratios were calculated. Okay, this is for the year 2022. We just calculated the ratios for 2023. The trade payables turnover ratio was 38 days and trade receivables turnover ratio was 33 days. So 38 days and 33 days. And now for the second part, we need to discuss the performance of Suki's business, comparing the results for 2023 with those for 2022. Alright, let us first compare trade payables turnover days. In the year 2022, it took 32 days for Suki's business to pay back to the supplier for the credit purchases made during the year. Whereas in the year 2023, we can see that now Suki's business will take 38 days in order to pay back to the supplier for the credit purchases. Since Suki's business will now take a longer period of time to pay back to the supplier, we can see that the trade payables turnover ratio has worsened in the current year as compared to the previous year, and this could also result in a deterioration in relationships with suppliers because now the supplier has to wait for a longer period of time to get the money back from Suki's business. Let's write this down. The trade payables turnover ratio has worsened which could result in a deterioration in relationships with suppliers. Now we repeat the same process with trade receivables turnover. We can see that in the year 2022, it would take 36 days for Suki's business to get the money back from the credit customers, whereas in the year 2023, it takes 33 days for Suki's business to get back the money from the credit customers. We can clearly see that in the current year, it took a lower period of time for Suki's business to get the money back, which is a good thing. So we can say that the trade receivables turnover ratio has improved, which could result in a reduction in irrecoverable debts. Since it now takes a shorter period of time for us to get the money back from credit customers, it results in a lower chance for any credit customers not being able to pay us back in time. That would definitely reduce the irrecoverable debts. Let's write it down. The trade receivables turnover ratio has improved, which could result in a reduction in irrecoverable debts. Now let's compare these two values for the current year. So we can see that it takes a shorter period of time to get the money back as compared to the period of time required for Suki's business to pay back to the supplier. So we can say that the credit customers will now pay more quickly than the payments which are to be made to the credit suppliers. So in the year 2023, credit customers pay more quickly than the payments made to credit suppliers. And the impact of this on our cash flow position is that since we are now getting the money quicker as compared to paying the money out to the supplier, it will definitely improve the cash flow position of the business. Let us write that down as well. This will improve the cash flow position of the business. Alright, this was of 6 marks, and we wrote 2 comments by comparing the trade payables turnover ratio over the 2 years. We wrote 2 comments by comparing the trade receivables turnover ratio over the 2 years. We made 1 comment by comparing the trade payables turnover ratio and trade receivables turnover ratio for the current year. And the final comment was for the impact of these ratios on the cash flow position of the business. That completes the second part of this question. Let's move towards the third one. We have been given the additional information regarding inventories at the opening date and at the closing date. We need to calculate to 2 decimal places the rate of inventory turnover, stating the formula used. So the formula that will be used in order to calculate the rate of inventory turnover is cost of sales divided by average inventory. So for the cost of sales, this is just going to be opening inventory plus purchases minus closing inventory. We have the opening inventory right here, 36,700. We have been given the purchases value above. That was 323,000. And we have the value for the closing inventory. This results in the value of 317,600. Then we need to calculate the average inventory, and the formula for average inventory is opening inventory plus closing inventory divided by 2. So the opening inventory in this case is 36,700, closing inventory is 42,100. divided by 2. This results in the value of 39,400. Let's substitute these values. So we have 317,600 divided by 39,400. And since this is the rate of inventory turnover ratio, the unit will be times. So the answer we get for 2 decimal places will be 8.06 times. That is all for the third part. Let's move towards the next one. We now need to explain the importance of the rate of inventory turnover to a business. So the rate of inventory turnover is a measure of efficiency of how well the business manages the inventory. Let's write it down. It is a measure of efficiency of how well the business manages the inventory. That is all for the third question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.